In modern finance, did you know there's a bond that also can transform into stock? That's right, one investment, two outcomes. Let's dive into convertible bonds. So let's start with the basics. What exactly is a convertible bond? A convertible bond is a hybrid instrument. It works like a normal bond, paying coupons and maturing at a set date, but also gives you the right to swap it for company shares. Because of this conversion feature, coupons are usually lower, making financing cheaper for the issuer, though it may lead to future dilution. Now that we already know what a convertible bond is, let's look at the benefits for both the company and the investor. For the company, convertibles are a smart way to raise money. Why? Because they pay lower interest than normal bonds. Investors accept smaller coupons thanks to the conversion option. Plus, the company doesn't dilute its shares right away and can reach both debt and equity investors at once. For the investor, it's like having the best of both worlds. You get steady coupons and the safety of a bond, but if the stock price takes off, you can switch into shares and ride the upside. Protection on the downside, opportunity on the upside, all in one instrument. Alright, now that we've seen the benefits, let's check out the main types of convertible bonds. You'll see they're not all the same. COCOs, or contingent convertibles, are mainly used by banks. Think of them as a safety net. If the bank's capital drops too low, the bond automatically turns into shares or even loses value. Mandatory convertibles. Here, there's no choice. When the bond matures, it must turn into shares. Like it or not, you're ending up as a shareholder. Vanilla convertibles. These are the most standard type. Investors have the option to convert the bond into shares, but they don't have to. Usually, conversion is possible at maturity or under specific conditions, giving flexibility to the holder. So, we know what convertibles are and their types, but one of the most interesting parts is how they show up in the books. Let's break down the accounting side. In accounting, the proceeds of a convertible bond are split between a debt component and an equity component. Over time, interest accrues on the debt. At maturity, the bond is either repaid in cash or converted into shares. Theory is good, but it's even better with a real case. Let's see how a famous company actually used convertible bonds. Take Tesla, for example. Back in its early years, the company wasn't even profitable. Issuing regular debt would have been super expensive. So what did they do? They turned to convertible bonds. This way, Tesla raised money at much lower interest rates, while giving investors the chance to win big if the stock took off. And guess what? It did. Those who converted their bonds made huge gains. More recently, in 2021, many tech firms copied this play, using convertibles to raise cheap money while riding their sky-high valuations. At the end of the day, convertible bonds are built on trust. Companies trust that investors believe in their future, and investors trust that growth will make conversion worth it. They're one of the most elegant hybrids in finance. Half security, half opportunity. Or, as I like to call them, the financial instrument that lets you have your cake and eat it too.